Yahoo Finance's Julia La Roche speaks to some of the biggest names on Wall Street and in finance, and she's speaking today with bond king Jeffrey Gundlach. So let's go to Julia now live. Julia?
Well, thank you so much, Adam. And Jeffrey Gundlach, founder and CEO of DoubleLine Capital, thank you so much for having us here for your investor days. So I think it's best to start with your overall view of where we are in the markets. What do you make of what's transpired over the last year plus?
Well, we've had a relationship between the Fed growing its balance sheet and the value of the S&P 500 that's been in place for years now, ever since they started quantitative easing. And it's almost like a law of physics. It's like if you take the capitalization of the S&P 500 and you divide it by the Fed's balance sheet, it looks a lot like a constant. And so once the Fed started quantitative easing, that reversed the stock market's collapse from the pandemic, and they've slowed it down a little bit because they were doing it at such a breakneck speed, but now they're continuing to do it. And so the stock market continues to be supported by that. Also, the valuation of the stock market, even though it's really high by historical comparisons, we also have very low bond yields relative to inflation, particularly this week. We have, the CPI came out at 4.2 year over year, and then the PPI is up at 6.2 or something like this, and bond yield on the 10-year Treasury is at 1.65. So the yields are so negative. So when you look at the classic relationships like PE ratios look elevated, the Dr. Shiller's cyclically adjusted CAPE ratio is kind of matching those of all-time highs, and yet weirdly, if you look at E divided by P, which is a yield on stocks, it's below average in terms of its valuation versus bonds. So the Fed has been manipulating markets for a long time, and on top of that, obviously, we've had incredible amounts of free money, fiscal stimulus. Last month, there was another round of checks, and I don't think a lot of people are aware that about a third of last month's personal disposable income was given by the government. Also, the government is running a deficit that's about 30% of GDP in terms of their spending, and they're only paying for a little less than half of it. So there's a lot of distortions that are going on, but with the money that's flowing, it's helped to distort many economic theories and also the value of most asset classes.
I was going to ask you, if we move beyond markets, and you're talking about distortions, where are you seeing those distortions taking place in the economy?
Well, the housing market's a good place to start. Home prices are up very strongly over the past 12 months. I think the median home price in America is up 17% year over year. And there are some markets that have been particularly attractive for people that are maybe rethinking their life in view of the pandemic that are up 30 or 40%. So there's a massive distortion there. Also, we have this strange thing of 8 million job openings. And everywhere you go, business people are saying, I can't fill them. No one will take them. And it was obvious when they started these money giveaways that there was going to be an issue, because right away everyone noticed that a certain fraction that was not trivial of people are making more money sitting at home watching Netflix than they are at work, and they don't want to go back. I think one of the dangers that we've opened the door to is these stimulus checks are starting to feel like they might not go away. They seem like there's always another round of them. In fact, this week, Gavin Newsom, the governor of California, has announced $600 to people that are making less than something like $75,000 a year, because California, thanks to the government money, has gone into a large surplus of their budget, at least temporarily. So now in New York, state of New York and state of California, a lot of people are getting $57,000 per year tax-free by not working. So there's a lot of distortions there. We've seen big distortions, partly due to government programs, but partly due to the pandemic. We've seen a lot of distortions with automobiles not being available. I actually bought a truck a couple of weeks ago, and the car dealer, it was a big car dealership, they had no new trucks. There weren't any. Now that's partly due to the chip shortage, but all he had on his entire lot were 2 used trucks. And the price, the one I bought was used at 8,000 miles on it, the price was only $2,000 less than the sticker price of a new truck. And the fellow who sold it to me, he claimed, and I think I believe him, that he was doing me a favor because he probably could have sold that truck, thanks to shortages, for more than the manufacturer's sticker price. So a lot of distortions. Also, average hourly earnings are very distorted because a lot of the people that were displaced from their jobs were the lowest wages. So when we look at economic statistics, we have to understand that there's been a huge mix shift. The types of people that are in the mix of average hourly earnings are higher baseline job earners. So average hourly earnings looked like they really spiked, but you have to take the mix shift into consideration, and it's kind of hard to do that. So I was talking to Felix Zulauf today, and we were talking about how murky the crystal balls have become because we have such different data sets than what we had historically, thanks to the sudden shock of the recession, but also the way it was very unevenly felt in the economy. My profession, investments in finance, actually hasn't had any growth in unemployment at all. But when you go to, obviously casino operators and Carnival Cruise Lines types of people, they have a very large shock that's taken place. So we're trying to figure it all out, and it seems to me that interest rates are starting to get loosened up a little bit on the upside. We had that incredible decline where the long bond in the United States went to exactly 1.00% intraday, and now it's up at 2.4. So I don't think a lot of investors are aware how much money has been lost if you panicked into treasury bonds back last March or April. I mean, we're talking about losses that are pretty substantial, about 30%. It's equity market type of losses, and your potential reward was a 1% interest rate per year for 30 years. So lots of imbalance risk reward was brought on by the pandemic.
You have to kind of wonder, who wants to own government treasuries right now?
The Fed. The Fed is the one that wants to own them.
Yeah, can we talk about inflation for a bit? This is such a hot topic right now, and we hear the two sides of the debate, that it's transitory, others who say it's going to be more rampant. When are you going to start to get worried about inflation and the consequences?
I think it feels to me like the market started worrying about it a little bit this week, because the CPI print of almost 0.9, I think it was 0.9 on the core and 0.8 on the headline, was the biggest miss on CPI in many years, and maybe even in my whole career. The guess was for 0.3, and it comes out at 0.8, 0.9. And that really shocked everybody. We have a model of inflation at DoubleLine that's quite helpful for a few months forward. It goes off of a couple of variables. It's been quite accurate. We knew that inflation was going to go above 3.5, but we thought it was going to be in a month or two. And so the fact that it's already leapt up to 4.2, I believe in our model that it's probably going to go higher in the next couple of months. The peak might be in July. If we keep going higher from there, then I think people are going to be seriously worried, because the concept of transitory has everything to do with what they call base effects. You came off very low numbers, and it's almost like Mount Whitney is right next to Death Valley for a reason. With the big hole in the ground, the dirt has to go somewhere. Inflation got so low that it was a natural rebound. But one thing to think about, the CPI is kind of a false construct. They use things like owner's equivalent rent to calculate shelter inflation, and owner's equivalent rent for the last 12 months is up 2, but the median home price is up 17. So if you would replace owner equivalent rent with home prices, the inflation rate actually would have been 8% year over year. So there's reasons for people to worry about inflation. The Fed, I think, likes to talk about transitory. I think the Fed is most content when the inflation rate is higher than the bond yields all the way across the yield curve, which they've managed to accomplish. So they're trying to make people not scared about inflation by calling it transitory. But how do they know? How does anybody know whether it's transitory or not, given the unusual circumstances that we're in? Don't forget that Ben Bernanke, way back in the day, he had a completely wrong interpretation of the dire nature of the mortgage crisis. He said it was confined to subprime, and it was many, many times worse than that. So I'm not sure how they know it's transitory. When they all say the same talking point, it starts to sound like some of the mainstream media, where every single guest from either the tribe on the right or the tribe on the left has the same talking point. So you wonder if it's just a brainwashing mechanism that the Fed's trying to get investors into on this transitory stuff. But I'll get worried if the inflation remains elevated through the summer. And I think the bond yields would start to test the Fed's resolve. They say there's no limit to their quantitative easing and stuff like this. We'll see, because if the rates go up, the few buyers that there are for treasuries, foreigners have been selling for years, domestics have been gently declining in their ownership, all you got's the Fed. And so with all of the debt that we have, which is, it's really, the deficit's really, the true deficit's about 20% of GDP, absorbing those bonds, if inflation stays high, is going to be a really big problem. And if you can't absorb those bonds and the yields are allowed to rise, well, that's going to be really problematic for the valuation of the stock market, which is depending on zero short-term interest rates and suppressed long-term interest rates via quantitative easing.
I want to go back and talk about, we were just discussing stimulus and the enhanced unemployment, and you were talking about maybe the stimulus might seem that it's going to continue. Do you think we're opening the doors up for UBI?
I do. I mean, I think we're already there. We had basic income way back in the 1960s that's still with us, with welfare programs and the like. And now we've been expanding it and expanding it. And yeah, I mean, there's a lot of conspiracy theories that typically should not look attractive, but with the deficit going up so much, and the debt now pushing 29 trillion, it's almost like they're moving into UBI and even sort of a wealth tax sort of situation by having the deficit so big that where are you going to get it from? But yes, UBI has been expanded. It hasn't shrunk at all. We started out, with checks from the government. People thought it was going to be one. It was going to be a few months of unemployment, further assistance, and it's been extended and extended. And not only is it being extended, it's being increased, as I just said, in California and the federal government. My guess is that they're ready to roll out another one, because that's just been the pattern. I was most struck when President Biden signed the bill. I think you kind of lose track. There's so many of them, but it's the $1.9 trillion one, and it had some benefits for certain parts of the economic structure in America. And it took all of 3 days for Nancy Pelosi and Chuck Schumer to clamor for those stimulus checks to be permanent. So they've already talked about the permanence of this type of stimulus, and people's behavior is already, I think, partly modified to kind of factor in ongoing government assistance. And the government doesn't seem to be discouraging them from thinking that it's going to be here for a long time.
I want to shift topics and bring up cryptocurrencies, Bitcoin specifically. I know you have commented on past webcasts about Bitcoin. We saw Bitcoin drop, I think it was something like 10% because of an Elon Musk tweet that came out yesterday about no longer accepting Bitcoin for payments of Teslas. You saw the news, but they'll keep it on their balance sheets. What do you make of what's been going on in the Bitcoin space?
The Bitcoin and the other cryptos have clearly been objects of speculation, and it had a lot to do, again, with the government money. I mean, remember the GameStop thing that happened too? All these things. A lot of people are just playing with this funny money. And when you give people money that don't need it, which unfortunately we've been doing a lot, they feel like they're playing with the house's money. So it actually does resemble a casino to them psychologically. Bitcoin, I thought, was really low at the beginning of 2020. I was really bullish on it. I went so far as to say I think it's going to go to 15,000 when it was at 4,000. And I looked like an idiot by the summer because it was still languishing at around 5,000 or so. But then all of a sudden it blew right through 15,000. And then all of a sudden it was 23,000. And that's when I turned neutral on it, too early, obviously, because it's now double that, and it was nearly triple that. But it's moving around like crazy. This is all based upon speculative fever. It's almost like every era of really highly valued markets, after they've run a lot, has some sort of a poster child, if you will. It was like some of the crazy .coms that had no revenue that were coming to market very successfully in the year 1999. Here, I think it's really these cryptos. And what I think is most interesting presently about Bitcoin is what you just alluded to, in that it's peaked. Now, maybe it's only temporary, that peak, But when you're looking at a speculative fervor, I look for the poster child to roll over last. And so these things are, the NASDAQ is underperforming the S&P 500, and it has been for a while now. It's this year to date, excluding today, because I didn't get the final prints, the NASDAQ was only up 2%, and the Dow Jones was up double digit. And so that's another sign that some of the speculative fervor might be in the process of dissipating, because for the longest time, the Super 6, which powers the NASDAQ, were tremendously outperforming everything else, and they just aren't anymore. So I always look for things that are sustained trends that get out of hand, and then quietly, without a lot of people talking about it, they roll over. And it's a sign that risk could be increasing. And I'm feeling that the market's more at risk now than it was thanks to the higher interest rates. Interest rates, I think if we take out the highs on the 30-year, which was around 2.5 or 2.55, I can't remember which, but we're at 2.4 today. So we're one really bad day away from going to a new high yield on the 30-year. I think that's something to watch out for as a risk factor.
So I think our viewers who are watching would be interested to know, what do you see in terms of, where are you finding opportunities, and what are you buying right now? What's interesting to you?
Well, I've been very bullish on commodities, and they've gone up almost every single day for the last year, and it looks overextended. So I think we're going to be taking a pause in the short term, probably on commodities. I think maybe the dollar might have a little bit of strength for the rest of this year, having been in a range-bound situation, but recently a little weaker. One of my recommendations in January that I still hold to is for fixed income investing. I think that floating rate corporate debt is good, like bank loans. There's the BKLN ETF. And it was having nothing but outflows during 2020 because people thought interest rates were going to be at zero for the rest of their lifetime. But now they're starting to factor in the idea that maybe interest rates, even on the short end, will ultimately go up. And the bank loans actually yield about the same as longer duration or longer maturity, other below investment grade credit. So I kind of like that. I think this will ebb and flow with the wiggles and jiggles of the market. But ever since we started DoubleLine until about 6 weeks ago or so, we never owned any European stocks. We hated them. We didn't like their negative interest rates. We thought there were all kinds of structural problems in the Eurozone. And we actually, thanks to the valuation and thanks to our longer-term dollar view, which is definitely a lower dollar. And I don't mean this year. I mean longer-term view. And I think you're going to be better off in European equities. So we actually bought some. And they've performed this year exactly the same or slightly better than US stocks. That's another one of these trends that seems to be changing. Just like the NASDAQ is no longer outperforming the S&P 500, suddenly non-US stocks are not lagging anymore. They are in Japan, and in China, but not in Europe. Europe is actually slightly outperforming, and that's another sign. The thing that I think it's too early for, that I like longer term, is emerging market equity. Just the emerging markets are having significant problems with slower vaccination, with inferior healthcare systems, and really struggling. I mean, emerging markets aren't up at all. So we have basically the developed markets are doing well, and for now the emerging, and emerging will do well, but I don't think it's this year.
Well, it's certainly something we will be watching. Jeffrey Gundlach, CEO of DoubleLine Capital, I thank you so much for your time. And for our viewers, we're going to continue this conversation, and you can watch that on yahoofinance.com. I'm going to send things back to Adam in New York. Adam?
Julia La Roche, well done. Especially, I mean, there's so much you're going to be able to pull for that our consumers will be able to watch on the platform. The warnings about universal basic income, Bitcoin, a lot of great material there. Julia, thank you. Mr. Gundlach, thank you.
Yahoo Finance's Julia La Roche sat down with billionaire bond king Jeffrey Gundlach, and she actually physically sat down with him, which is something we haven't been able to say in a while. And she did it at DoubleLine Investor Days in Los Angeles for an extended discussion. They talked about higher taxes and the California exodus.
Well, it incrementally helps, but I don't really think the tax proposals that have been floated come close to paying for the spending. I mean, I'm going to repeat that government spending is more than half paid for by deficit. It's an incredible fact that most people don't know. In fact, for the fiscal last year, it was 56% of all government spending was borrowed. Now, one thing about these stimulus checks is, on the surface of it, people might think, well, if we give money to the poor and we take it from the rich, we're going to help get rid of wealth inequality. But there isn't any historical reason to believe that that would be the outcome. Once we go into a unmoored type of monetary and fiscal policy, which is territory that we've entered, we can go back at history and look at what happened in prior examples. And it's pretty depressing to do that, because the outcomes are often civil wars, revolutions, like the French Revolution. They went off the gold standard in the 1770s, and by the late 1780s, there were basically riots about food. And there was the Women's March, where they started at the bread market because they couldn't get any bread. It was too expensive, or else there was a shortage of it. And they were so upset by it, they finally couldn't take it anymore. And they marched, the women started it, they started marching towards Versailles, where Louis XVI and Marie Antoinette were. And they did it in the pouring rain. And many of them, I suspect, didn't even have any shoes. So why did it come to that? Well, the money printing and the giving away ended up making the middle class poor, and the prior poor class was starving to death. And at the other end, the people who were controlling the levers of the money printing became more wealthy. So it isn't really the case that these tax increases will pay for this spending. And if we go to another level of free money, I think the wealth inequality will get worse. What do I think about the stimulus that's happening is it's being very beneficial to U.S. consumption, but it's not really developing our productive base at all. So we have more consumption, but the consumption is stuff coming in from China. So Chinese GDP is booming because we're buying all their stuff. And so that's exacerbating that problem as well. And it comes through, and I'm oversimplifying here, it comes through Amazon. Mm-hmm. Amazon does a very large share of this business. So we've got one of the richest people in the world, Jeff Bezos, is getting made fabulously more wealthy because of the government's giving money to the people that they are. And so that's kind of how the mechanism works. So the stimulus hasn't helped our productive base. It's helped China, and it's helped certain very rich people in Silicon Valley and the like. And that's where it is. I think the wealth tax is primarily vengeance, really. I don't think it raises very much money. And it just seems like I am in the camp that wealth taxes ladled on top of our current tax system basically punish success. Now, having said that, I would love to have a wealth tax, but only a wealth tax. I think wealth tax makes more sense than income tax. The income tax, though, system is so convoluted that it's almost nonsensical, and it's completely unfair. In 2012, Mitt Romney ran for president, and he put his tax return out, and he paid something like 14% in income tax relative to his income. I made about as much money as he did in that year, and I was paying 50%. So I don't like the idea that the income tax system is completely unfair, even at equal income levels, because of tax shelters and carried interest and all these things that are just crony capitalism, essentially, through the tax code. I would get rid of all of that and just have a wealth tax. But to put a wealth tax on top of the income tax, that's really problematic. You mentioned the capital gains tax. For those making $1 million or more a year, the proposal is to take it to basically 40%, which would really affect things very dramatically. That would be sort of a shock to the financial system, sort of like the pandemic was to the healthcare system. And if you put capital gains tax together with a wealth tax, then you've really got a problem. Because if you have a company that's worth $100 and they tax it between California, who's proposed 1%, and some talk in Washington of around 2.5%, you have a 3.5% wealth tax, and the tax collectors are the judge, the jury, and the executioner. They're going to tell you what your private business is worth. It's really worth 100. They might say it's worth 200. They're probably going to estimate it in their favor, which make the wealth tax 7%. So if you paid 6 years of wealth tax, it would be 42%, and then you sold your company for 100, you basically pay all of the proceeds from having done it previously with the wealth tax and then with the 40% capital gains tax plus California's tax, it's all gone.
Well, you mentioned California, and I live in Miami now, so I'm seeing a lot of Californians come in to that city. So in that scenario, you're a business person. You employ people. You have a business here in California. What would that mean for someone like yourself?
Well, I think it's one of these situations where you look around, and it seems like a lot of smart people who are wealthy that made their start in California have already left. You know, Elon Musk, Joe Rogan, you know, Ben Shapiro, Oracle, Hewlett-Packard, the big companies. I can tolerate it for now, I guess, but I'm at 13.3. If they take it to 16.8, which is proposed in Sacramento, and the federal goes up, it's going to be hard to really endure the California taxation. Plus, California services are among the poorest in the country, so you're paying a very high tax, and what we're receiving is an explosion in the past 18 months of homelessness, the infrastructure is crumbling, and crime is soaring, and yet you're paying ever more increments of taxation. At some point, I think basically they're going to realize everybody's going to leave.
What would be the first thing you would fix?
I would run a balanced budget.
There you go. One of the things we talked about last summer was, you know, you're talking about this kind of impending wave of white-collar layoffs. Where do you stand on that as it relates to future of work, and has that view been adjusted as we've seen kind of anecdotally more people who are white-collar jobs who are just kind of saying, you know, forget it, kind of taking off and resigning. Where do you stand on that prediction of the white-collar wave layoff?
I think it's still coming. I think it's middle management is what I'm thinking about. I think when you do things virtually, when you're working virtually, you don't almost need middle management. You kind of you're organized in a way where everybody's interacting, and I find that the Teams meetings and the Zooms, they give us an extra perspective into who's really working and who's just kind of watching other people work. And that's the basis for my thesis, that sort of middle management will probably be thinning the ranks of that. So we'll see. I think there's a lot of question marks relative to California, where we've been locked down more than other places, and there's a lot of confusion and varying ideas as to how to go back to work. So we polled our employees, and we're not very different from the broader surveys nationwide. A lot of people want to work from home a couple, 3 days a week, and that's a big shift. And I just think part of figuring out the plan of going back to work at offices, at least hybrid model, I think part of that will involve right-sizing your middle management force.
Well, that was DoubleLine Chief Jeff Gundlach, known as the Bond King, but talking about a lot more than bonds.